Hey everyone, welcome back to Corporate Decoder, the place where we uncover reports. Today we're diving into a report that's got a bit of a hiccup in it, a really interesting one about recognizing revenue. It seems like Kestrel Group Limited has a bit of a math problem from their past. So Kestrel Group Limited filed this Form 8K, which is for special events that shareholders need to know about right away. The big news here is they're saying some of their past financial statements weren't quite right and shouldn't be trusted anymore. That's a pretty big deal for any company. This all came about on August 11th, 2025. The folks in charge of overseeing the numbers, the audit committee, along with the company's management and their accountants, both current and former ones, realized something was off. They found out that the financial reports for the years ending December 31st, 2023 and 2024, and even a part of 2025 had mistakes. The core issue was how they counted their money, specifically when they recognized revenue from certain service deals. Think of it like this: if you provide a service over several months, you usually count a piece of that money each month. But it seems Kestrel was either counting it too early or too late, messing up the actual picture of their earnings. Let's look at the numbers. For the year 2023, it turns out they reported less revenue than they actually should have, by about $2.4 million. That means their business might have actually been doing a little better than they initially told everyone for that year. Now for 2024, the situation flipped. They reported more revenue than they should have. For the full year 2024, they overstated it by about $1.6 million. And for the first 3 months of 2025, they also overstated revenue by about $130,250. They also overstated revenue by about $139,000. This means they might have been celebrating growth that wasn't quite as solid as it seemed. These mistakes weren't just about the revenue number itself. They also affected the profit, the earnings per each share of stock, and the overall financial value that belongs to the owners of the company, known as shareholders' equity. So all the key metrics that investors look at were skewed. There's also a mention of mergers that happened around May of 2025. These mergers are quite complex, involving several companies coming together. The report states that $4,000, they believe, states that the total impact of these revenue recognition errors on the company's shareholders' equity in light of these mergers was about $674,000. They believe these errors, when you look at the combined company after the mergers, aren't significant enough to be a major of these mergers, was about $674,000. They believe these errors, when you look at the combined company after the mergers, aren't significant enough to be a major problem for the new bigger entity. What happens now is that Kestrel plans to go back and fix those old financial reports. They're working with their former accountants to file corrected statements. This is a common step when accounting errors are found, and it's important for keeping the market informed accurately. On top of the restatement, management has also admitted that there's a significant flaw in their own internal systems for checking financial reports. This material weakness means they need to improve how they apply accounting rules, especially regarding when to count revenue. This is a crucial point because it suggests the errors weren't just a one-off mistake, but pointed to a deeper problem in how they manage their financial information. Now, Kestrel Group Limited is listed on the Nasdaq Capital Market under the trading symbol KAGI. They have common shares which represent ownership in the company. And signing off on this report is Bradford Luke Ledbetter, the Chief Executive Officer. It's his responsibility, along with others, to make sure the company's financial reporting is accurate and timely. So what does this all mean for Kestrel Group Limited? Well, in simple terms, the company is admitting it made significant errors in how it reported its earnings in the past. While they say these errors aren't material to the combined company after recent mergers, the fact that a material weakness in internal controls was identified is concerning. It suggests potential weaknesses in their financial reporting processes that need to be addressed diligently. Investors generally like to see clean books and a clear history. This situation might raise questions about the company's internal oversight and the reliability of its past financial presentations. However, the prompt correction and restatement are positive steps toward rebuilding trust and ensuring future accuracy. The real test will be how effectively they can implement stronger internal controls to prevent such issues going forward. It's a situation to watch closely as they integrate their recent mergers and move forward. Alright, that's our breakdown of Kestrel Group Limited's filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.